Okay, folks, now we're heading into the latter portion of the course, the last week or two, few weeks here. And now we're moving on to investing. Now, just to kind of back up, so we've covered all these things that are associated with doing budgets, with setting up the different, most recently going through the different types of insurance and making sure that we have all of our I's dotted and our T's crossed so far as our financial health is concerned. And this is kind of the last thing and the first thing. The last thing in that when we're talking about investments, this is another way you could call it. This is about saving, right? And savings, back to what I said before, and I'll just go ahead and repeat myself. When we talk about income, income goes to three places. Income goes to consumption, income goes to taxes, and the residual, whatever's left over, goes to deferred consumption or savings rather, and that goes into what? Into investments. That's what we're talking about, investments. So that's kind of that's kind of what's left over. But and what I'm going to refer to again is that term that I used in the past, and that is that you have to pay yourself first. And that's what this is. This is the time when you are paying yourself, when you set aside something in savings, and you go through this investment process, investing wisely, and so on and so forth. Anyway, onward we go. This shan't be too long. This lecture, if you will. So anyway, so first, the learning objectives describe why you should establish an investment program, assess safety risk, income growth, liquidity effect, and the liquidity effect rather of your investment decisions. Objective 3, explain how asset allocation and different investment alternatives affect your investment plan. Recognize the importance of your role in a personal investment program. It's all about you, in this case, right? Finally, use various sources of financial information to reduce risk and increase investment returns. That's what it's all about. You want to maximize your returns, right? So first one we're looking at is describe why you should establish an investment goal. So the basic idea, of course, is that you want to you're setting something up, going along with all these other items that we talked about, insurances and different things that we're doing for our financial health. But the investment thing is, think about it this way. You're working for 30, 40, 50 years. That's your work life from age, we'll just say 16, 18, 22, etc., up until you're 55, 65, 75, etc. And this is what you're going to be using after when you're in your golden years, if you will. This is what's going to support you when you're not doing what? When you're not employed. So basically, this is your unemployment benefit that you'll be paying yourself. This is the result of your investments when you actually decide to liquidate your investments. Specifically, investment goals must be written, again, specific and measurable. So you've got to sit down and go through this in your head. How long does it that you want to work? And this is when you have to be brutally honest with yourself too. How long you're expecting to be retired. And when you're young, you try not to think about these things too much. You don't think about them, but it's worthwhile just to go through it in your head and to try to come up with some reasonable plan to start with, because what's going to happen is that's going to change going forward. Always does, always will. So establishing your investment goals, again, so what possible economic or personal conditions could alter your investment goals? This is again, what I was describing is that this is going to change over time. When you're young, you're thinking you're going to retire when you're 30 years old, and not think about it. So if you retire when you're 30 and you live until you're, we'll just say 80, you have to have investments that will last for how long? For 50 years. Not going to happen for most people. 99.9% of folks, okay? So you've got to think about these things as you're kind of going forward. So you develop, again, valid goals, asking yourself such things as how much money do you need to satisfy your investment goals? How long will it take you to obtain the money? And how much risk are you willing to assume in an investment program? And this goes back to something we talked before about life cycle hypothesis. When you're young, uh, you're 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 consuming more than your income allows it to start with. But remember back to what we said before: you pay yourself first. And when you're young, you should definitely be have your investments skewed more toward risk than towards safe investments, meaning that you would higher rates of return would be coming from stocks, and more specifically, and we'll get into this, mutual funds that are stock-based mutual funds, index funds, and we'll get into that again as we go forward. When you're young, that way, when you get older and you're approaching retirement, then you start thinking more in terms of safety, right? When you're within that 5-year window, we'll say. Lastly, are you willing to take sacrifices necessary to reach your investment goals? With every opportunity that you have, there are going to be risks and there are going to be sacrifices that are associated with that. Remember, opportunity cost, the trade-offs that are involved, deferring consumption, sacrifice, because you're much more inclined to spend it now and not worry about tomorrow, right? So establishing investment goals too. What will be the consequences? What will they be if you don't reach your investment goals? Think about it. You're 65 years of age and you've got zero savings. All you're going to be able to live on going forward, assuming you worked this entire time, is what? Your Social Security. And that, I know that many people are concerned whether or not that's going to be around. It will be, but it may be less than what you anticipate to start with. And it's never enough it was never meant to be the entire, your entire investment portfolio, Social Security. So given your economic circumstances, are your investment goals reasonable? Uh, you start out with best of intentions. You're going to be saving $10,000 a year, for example. And the reality is that you're lucky that if you can save $500 a year to start with, or $1,000 a year, et cetera. The point is that think about the reality and don't start out. How do I want to say it? Don't put yourself into that failure mode to start with. Okay. Setting yourself up for failure. You do what you can. Pay yourself first, even if it's $5 a week. Do something, okay, along those lines, right? So, ethical concerns: paying your bills on time, work to balance your budget. Do you regularly spend more than you make? This is the reality. Back to what I was saying before, is that when you're young, in particular, there's a tendency to spend more than your income will allow. That's why we have to borrow and so on and so forth. So this is a disciplined approach, meaning that you try to, you recognize the reality of situations and you try to move toward a status of your own where you're covering your bills and you're balancing your budget. And this is all very, very important. So managing your credit card debt again is an adjunct, if you will, part of the previous, and that is that the objective is to pay off your credit card, not carry any debt because there's interest associated with that, paying off your credit card bills every month, using that as kind of a piggy bank that's paid off on a monthly basis. So you're buying something on credit, but you're paying the balance off every month. That's the objective. It's not the reality. Oftentimes, sometimes some months you won't be able to, but you have to really be careful tracking this because you can go upside down very quickly, and it's hard to pull yourself out of that hole. What's the expression? If you're in a hole, stop digging is kind of the point, right? So you start back to what we said before about having this emergency fund, because there's always that anxiety. What happens if you lose your job tomorrow? So you start focusing on, this is paying yourself, if you think about it. Try to set aside that 3 to 6 months of living expenses, which also feeds into when you talk about your budgets. Can you afford that new home? Can you afford that nicer apartment? Would you be better off going with something a little less, a little more austere, a little less ostentatious, right? You're probably better off, again, living within your means, having access to other sources of cash, again, for these emergency needs, line of credit, with your bank, with your financial institution, the possibility of a cash advance on your credit card that you don't access unless you truly need it. So different economic factors that affect your personal finances. The economics is a study of how wealth is created and distributed. I like to look at it as economics is really the study of scarcity. And we're all bounded by that scarcity, meaning that we can't have everything that we want, but we can try to get the things that we need. And this is kind of the focus, is to focus on that. And yes, it has to do with wealth, the creation of wealth, and the distribution of wealth and income, and so on and so forth. But anyhow, so the major factors that can affect the economy, your personal financial plan, the value of your investment include actions the federal government may take to maintain a healthy economy, and this would be monetary policy through the Federal Reserve, with interest rates, driving interest rates up, driving interest rates down, along those lines. And there are also federal government in terms of, on the legislative side, in terms of taxes, higher tax rates, lower tax rates, try to stimulate the economic growth, and so on and so forth. The business cycle, essentially what that means is that when the economy goes into recession and comes back out, it does go through this. It does have a circular pattern. And the reason, another way of looking at this, is that when it goes into these cycles, the down cycle in particular, the down part of it, that's when the economy is actually failing. So this is these valleys and peaks and so on and so forth. This is irregular growth. This is the reality. However, you could do that, goes into another econ course. We'll leave it at that. So managing your money with regards to that economy, establish a larger than usual emergency fund if things look bleak. If we are heading into a recession, you pull back on your spending. This is the normal course of action for consumers. Knowing what you owe, understanding what your balances are that are out there. This goes back to maintaining a budget, maintaining not just your forecast, but your actuals, what you're actually spending, reconciling your checking accounts, and so on and so forth, and responding accordingly. This is, again, if there's an economic downturn, you pull back on your spending, especially on such things as higher ticket items like vehicles and so on and so forth, right? And if you get into trouble, back to what we were saying before, the wisest course is to contact the credit card company right away. They'll probably put you off and say, oh, you've got to pay your bill, blah, blah, blah. But so long as you let them know, you are in a better position, that you're not just putting your head in the sand, right? Anyway, monitor the value of your investment, the retirement accounts. When we say this is not something you do on a daily basis. If you do, you'll drive yourself crazy and you'll tire of it very quickly, and you'll end up losing money because you'll be pulling money out and putting back in, blah, blah, blah. You monitor this, meaning you're looking at this, but you kind of stand back. Not to say that you're not actively involved in making changes if you think that they're necessary, but you have to think about these things. Consider converting investments to cash to preserve value. And this is, again, this is in the case of when there's a recession, lack of inflation, moving closer to cash. It's just kind of a natural reflex action that occurs. So getting the money needed to start an investment, this is always a tough part. How badly do you want to achieve your investment goals? So the priority, if you will, of those investment goals would include, again, how badly you want to achieve your investment goals. Are you willing to sacrifice some? Are you willing to defer consumption to finance your investments going forward? Take advantage first and foremost if you're working for someone else. Take advantage of the employer-sponsored programs, whether we're talking about 401ks with private employers or 403bs or whatnot with public sector, working for government. If they don't have matching, at the very least, it's a program that would be set up for you where you can set aside something, paying yourself first. Yes, it reduces your income, but these are, one, they're pre-tax dollars, and two, you are paying yourself first in doing so. And participate in elective savings programs is what goes along with the employer-sponsored programs, and it would also include such things as IRA, individual retirement accounts, et cetera. We'll get into this as we go forward. Automatic payroll deduction, set this up automatically so that you never see it. If you don't see it, you don't miss it. I say that guardedly, but that's absolutely the truth in my experience. And whatever tricks you can employ. In this case, we're saying make an effort to save 1 or 2 months each year. If you can do it on a regular basis, if you're paid weekly, bi-weekly, twice weekly, monthly, however you're paid, if you could just set something aside, and then it goes back to that automatic payroll deduction, just set it and forget it. How time value of money affects your investments. Remember, time value of money, the longer you're away from your money, two things happen. The higher the interest rate in general, and also the quicker that your investment is going to grow. Remember the rule of 72. 72 divided by the percentage rate of return. So if you take 72 and say you're getting 8% rate of return, 72 divided by 8 is 9, or in 9 years your investment doubles. Plus, on top of that, you're adding more in over this period of time, so it's increasing even more so. This is why you have to step back and really, really think about these things. And this is why the term I'm using is set it and forget it. Start plunking your money in, know where it's going, and we'll get into that as we go forward. But start setting money aside into your investments, and if you step back and let it happen, it will grow. Okay. You have to be, of course, in safe investments, et cetera, but we'll talk about that. Again, small sums grow over a long period of time. Rule of 72. Deposits along with investments earning accumulate, back to what we said before. Rate of return makes a huge difference. Back to the rule of 72, if you take 72 divided by 8%, that gets your money doubles in 9 years. And if you're getting 4% rate of return, it takes double the time. So it takes 18 years for your investment to double if you're only getting 4% rate of return. Which, of course, there's a higher risk associated with the 8%. But when you're younger, in particular, your investments should be you should be able to carry a bit more risk, and we'll talk about this again. So look for investments that postpone taxes, such as IRAs and 401ks, etc. And what that means is that these are taken off, reduces your taxable income. Right? You have to pay taxes later; it's deferred. However, it also helps you to grow your investments more quickly. Right? So factors affecting your choice of investments: assess how safety, risk, income growth, liquidity affect your investment decisions. You've got to make a decision. Back to what I said, when you're young, you can afford more risk. And if you avoid risk entirely, the risks associated with interest rates and whatnot, the problem with that is that you may not even keep up with inflation. You'll have a very, very low rate of return. Anyway, safety and risk. Safety in an investment means minimizing that risk, if you will. Risk means a measure of the uncertainty of the outcome. Investment range from safe to very risky. Speculative investment, that's obviously at the at the very, very end of that risk, that, from safety to risk and moving on from just that plain risk out to very, very risky. And this is back to the old saying, if it sounds too good to be true, guaranteed it is too good to be true. It won't last. So risk tolerance and calculating return on investment, evaluating your tolerance for risk. These are things that you've got to think about, and think about them very hard, because this is a choice. This is where you're going to kind of insert yourself into this continuum between zero risk tolerance to high risk tolerance, understanding the trade-off that's going on. The higher the risk, the greater the rate of return, the greater the possibility of not getting that return, that anticipated return. So you have to have some balance in looking at this. So you've got to get above it and look at this from as an objective standpoint as you possibly can. Choosing higher risk investments, investors expect higher rates of return, right? That's straightforward. The potential return on any investment should be directly related to the risk that the investor assumes. Remember, because what you're doing is that you're giving somebody else your money, and in exchange for giving them your money, you expect a rate of return. And the riskier is that investment, the higher the rate of return that you would be expecting. So calculating that rate of return, you determine the change in investment value just by adding or subtracting, decreasing the decrease, if you will. Add annual income to change in value, divide by the original investment's value. You're coming up with whatever that rate of interest is, and the objective, of course, is that this is, again, I'll use this as a rule of thumb. If we're looking at stocks overall, it looks at what you can expect, so long as you've got some sort of a balanced fund, if you will, that you have things in. And we'll get into that index fund, looking at about an 8% rate of return versus debt or bonds, which, at least in theory, are a little safer and lower rates of return as a result. They probably average overall about 6%. All right. So again, rate of return, the example, assume you've got $3,000 in a mutual fund. We'll just walk through this one. This is a good example. Also assume that the mutual fund pays a $25 dividend this year, and that the mutual fund is worth $3,275 at the end of 1 year. Your rate of return is 10%, as illustrated below. So you take, again, the rate of return is equal to the increase or decrease in value plus the annual income, that's the dividend, divided by the original value. We're just looking at 1 year. So increase of $275, your dividend of $25 divided by that $3,000 initial portion of it, your initial investment, if you will, and that gets you $300. And that is, of course, 300 divided by 3,000 gets you a 10% rate of return on your investment for that given year. Right? So different risks. This is where we walk through, and it gets kind of, risk is always present. So keep that in mind. You're not going to completely eliminate risk. You just can't do it. Here's an example. The least risky thing that you can buy from perspective, from a safety, or typical like losing your investment type of a scenario would be a U.S. government bond or a Treasury, U.S. Treasury security. And think about it. This is the U.S. government. Yes, we've got a huge amount of debt that's out there, but the fact of the matter is that the U.S. government has always paid its debts. They've always paid the interest that's owed on the debt that's out there. So going from that point, inflation risk. So if there's high rates of inflation, and if you're not keeping up with that, if you're too risk averse in terms of possibly losing your investment, for example, that results in a lower rate of return, lower interest rate. And if you're not keeping up with inflation, that's inflation risk. Interest rate risk, this is the value of your investment. Again, when you've got a fixed rate of return, if you've got, think about it this way, you loan somebody, some money, it doesn't matter who. This is what a debt instrument is, by the way. It's you are loaning an entity, whether we're talking about corporations um, or government, as I mentioned before. You are lending somebody something at a given rate. So you're buying securities. You're buying, in essence, you're receiving an IOU in exchange for your money, and it's at a fixed rate. So the problem, of course, is that when you have interest rates rising in the economy, the result of inflation, et cetera, then that interest rate that you're getting doesn't change, and as a result of which, the value of your security, the value of that instrument that you have in your possession, is not worth quite as much, right? So business failure risk. This is again when you could lose the whole thing, um, you could lose the value of your investment entirely. So there's that market failure risk, et cetera, that would be associated with that. But so prices fluctuate again because of such things as systematic risk and unsystematic risk. And we don't get into this in too much detail, but you can this is when we talk about market risk, is you can't you can't know where the market's going to be going. Market goes up and down. Your investments are going to go up and down. But the truth of the matter is that if you have all of your eggs in one basket, you're more susceptible to what? To realizing some risk that it could really be devastating for you. So this is why you spread that risk. You're reducing your risk by spreading this over the entire market. So you're reducing at least that component of the risk. The entire market's going up and down, for example, but if you can spread your investments out, you can track that at least, and so you're protecting yourself against having a single investment that's really, really bad, right? So global investment risk, this is evaluated by domestic investments. We diversify when the U.S. markets are in decline. So this is foreign investment is what we're talking about. How the U.S. Your investment is in terms of the international scope of things, if you will. So walking through the different types of like going from safe to not quite so safe, if you will. So predictable source of income, passbook savings account, very, very low interest rates, of course, certificates of deposits, similarly low interest rates, securities, again, issued by the U.S. government, very low interest rate, but they're what? They're very, very safe, all of these. They're protected by insurance, and lastly, the U.S. government securities are protected by the good name of the U.S. government, meaning you and I, right? Higher potential income investments would include such things as mutual bonds, municipal bonds, corporate bonds. So we're getting into the riskier territory, but there's a higher rate of return. Preferred stocks and common stocks, and moving into the area that we'll talk about in much greater detail later on, would be mutual funds. Mutual funds are, if you buy, say you have one share of a stock, if you will, in a mutual fund, and it depends upon what the mutual fund is, of course, but the mutual fund is going to take that money that you invested in one share and they're going to spread it out over the market. So they're diversifying for you in essence. And you can start out with a very, very low dollar figure, especially I don't mean to plug different mutual funds, but Vanguard, Fidelity are very good in terms of having low cost, and especially if you look at the broadest based index funds that you can kind of get your hands on, if you will. And anyway, more risky would be, again, real estate rental property. This is called a REIT, real estate investment trust. And yeah, they can be more risky, it can be less risky, but these are things that you could potentially have a much higher rate of return on. So investment growth and investment liquidity. Remember, liquidity means how quickly you can turn that into cash, and within a safe. So your investment's worth $50. How quickly can you get that $50 back in your pocket? Is it going to take you a month to get the $50, or can you turn it over in one day, but you're going to take a hit on that $50 and drive it down to $45? This is when we talk about liquidity. How quickly you can turn it into cash, and how safe that investment is in terms of knowing that the value is constant or steady. Anyway, investment growth. Growth means investment will increase in value. Common stocks, again, growth companies pay little or no dividends but reinvest in the company. This is, think of Google or a lot of the higher tech ones that there are two ways that you can receive compensation if you buy a stock. One is with dividends. Dividends are profit sharing for owners or shareholders, if you will. So you get your dividends on a quarterly, I think it's semi-annual or an annual basis typically, where you receive a dividend on per share of stock that you have. And the other way of having an increase, or it changes the value of your investment, is that you buy a stock for $10 today and you hold on to it for 5 years, and it goes from $10 up to $50, right? So that's called capital gain specifically. Okay. Well, anyway, select mutual funds and real estate they also offer significant growth potential, investment liquidity. Again, we've already talked about that, the ability to buy or sell an investment quickly without substantially affecting the investment's value. Back to the whole thing we said before about home ownership, is that real estate is not a very liquid investment at all. Onward, asset allocation. Explain how asset allocation and different investment alternatives affect your investment plan. So straightforward. Asset allocation is the process of spreading your investment over a large number of assets, and then you buy them on a regular basis. So asset allocation, again, is a process of spreading your assets among several different types of investment to lessen risk. And anyway, onward. So the time factor involved, this goes back to the time value of money. The longer you have invested, the better your opportunity for increasing your return. And the other part of this that we're looking at is your age. As we said before, when you're younger, you can afford to have much more risky investments, if you will, where there's going to be ups and downs. When you're older, not so much, perhaps, right? So this is when you're older, when you're close to retirement. We'll just use 5 years as an example. You would definitely want to consider moving your investments from higher risk investments to lower risk investments at that time. So moving from more of a stock portfolio or mutual funds, stock-based mutual funds, for example, to bond-based mutual funds as you get older. It's because you want to have more certainty, you want to have more safety. And of course, the downside is that your rate of return is going to be less. So, and back to this is actually a nice representation. Starting at the bottom, very, very low risk. This is just looking at the different types of investments that are out there. Cash, of course, CDs. So basically, the closer you are, if you will, in some ways to what? To cash. So there is that aspect of it. So U.S. Securities, again, selected corporate, this is still on the debt side. These are bonds, and moving into income stocks and conservative mutual funds. What that would have to deal with is buying blue chip stocks and buying stocks and companies that are pretty steady earners, if you will. So they've got slow growth. There's a higher certainty of increased income, but at a very, very low rates, as opposed to growth stocks and growth-oriented mutual funds and rental properties. And the last of them would be speculative stocks, options, commodities, and other high risk investments. If you don't know what you're doing at the speculative end, then that's something that to be very, very, very wary of, if you will. So anyway, you get the idea. It's actually again a nice representation. So when we look at at finance and we look at securities, there are two types. One is equity, and the other is debt. So we talk about equity finance versus debt financing. It's equity has to do with stocks, and debt has to do with bonds. Keep that in mind. So equity capital is money that a business obtains from its owners, stockholders, buy shares of the company stock. Stockholders are the owners. So if you have a share of stock in a company, you are that portion, whatever that portion is that you own that portion of the company. And as a result of which, the main difference is that the face value of a stock versus the face value of a bond. The face value of the stock says that you own one share of the stock, and what happens to the price or the value of that stock? It goes up and down all the time. On a second by millisecond basis, the stock prices go up and down, as opposed to debt or bonds, where you know on the face value it'll tell you exactly what the terms are, what how much this is worth, the face value of it, how much interest you're receiving, the terms, all the terms, the maturity date, when you can get your overall investment back, and all the terms that are associated with that loan. That's what debt capital is. So anyway, onward back to the equity portion of it. There are two types of stock that would be associated with the company. One is common stock, one is preferred. The difference between the two is that common stock is that you have the right, you have voter rights. Preferred stock, you can't vote. However, preferred stock, you're the first one to receive dividends. You're the first one to receive that profit sharing, if you will, in the form of dividends. Common stockholders are the last in line in terms of being paid, and especially in terms of bankruptcy. Bankruptcy, typically, this is historically been the case, but there are a few instances when this didn't happen. We won't go there. Is that if a company goes bankrupt, the first folks that are paid are the debt holders or the bond holders. The second would be, in terms of the stocks, would be preferred. Last would be common stockholders, whatever the residual value holders are. Okay. So again, back to what we have here is a corporate and government bonds. Corporate bond, it's a loan to a corporation. Whether we're loan to a corporation, a bond is also for governments and or municipalities. Bondholders receive, again, very specific, how much interest is being paid and when that bond actually matures, when you can turn it in and get your principal back. So if it's a $10,000 bond, it depends upon the terms, but just say in general, you're getting 5% rate of return, annual rate of return. So you're getting 5% annually for lending some entity, whether we're talking about a corporation or government, a certain amount of money over a certain period of time. You're getting interest over that period of time, and then at the end you get the principal back, the $10,000 back. It all depends on, there are different types of bonds that are out there. But anyway, bondholders can keep the bond until maturity or sell it to another investor before maturity. And this is when we start talking about the relationship between interest and price. So if interest rates go up, if you have a bond with a stated value on it, interest rate wise, interest rates go up, the value of the bond that you're holding is going down. Think about it. The overall interest rates are at 5%. You buy a bond at 5%. And 2 years down the road, this is a 5-year bond, for example. 2 years down the road, interest rates go from 5% up to 10%. So all the new issued bonds are coming in, for example, similar bonds, 5-year bonds are coming in at 10%, meaning that the bond holder is being paid 10%. what do you suppose happens to the value of the bond that you're holding that's receiving 5%? The value of the overall bond goes down. You can sell these bonds. That's the beauty of them. They are convertible for the most part. Anyway, so mutual funds, their investors' money is pooled and invested by a professional fund manager. You buy shares in the fund. Again, you buy $100. The share price is $100 in this mutual fund. And so the mutual fund takes your $100 and spreads it out over all those investments that they have. And so there could be 50, 500, 5,000. And it's spread out according to whatever the dictates, if you will, are of the mutual fund. And anyway, this is, again, the objective is that it helps you to diversify and reducing your risk in that regard, right? Back to that systematic and unsystematic risk. Funds range, again, similarly from conservative to they can become very speculative. And you have to match your needs to the fund's objective. They're stated in what's called the prospectus. You have to get a good handle on these things. So again, if you're young, you should take on a fair amount of risk, because the more risk that you take on, the greater the return potential. Remember, it can go up and down, but overall, if you've got 20 years, chances are your investment will go up over 20 years. It'll go up and down, but your investment today should be worth significantly more. So this is, again, one of the beauties of mutual funds, is you can diversify some of that that risk that's associated with the market, the business failure, for example. All right. Anyways, the responsibility for choosing the right mutual fund is based on your evaluation of a mutual fund investment, what it is that you want, how much. So things to consider before you make a decision to buy any property is, for example, is the property priced, again, competitively with similar properties. All these things are same, straightforward. What type of financing is available? How much are the taxes? Conditions of the buildings in the immediate area? Why is the present owner selling the property? This is a repeat, sorry about that. Is there a chance that the property itself will decrease in value? And they can. Other investment alternatives, speculative investment is a high risk investment. Includes such areas as stock or options, commodities. We see this, the price of corn and the futures prices and so on and so forth. Derivatives, which means that you're going beyond the. And if you can get into these things, especially if you go into like as a finance major, you get heavily into into classes where you get into talking about options and commodities prices and derivatives and so on and so forth. And beyond that, of course, would be precious metals and gemstones, coins, stamps, antiques and collectibles. All these are other potential investments that are out there to consider. So you have a personal plan for investing again, establish your investment goals. Back to what we were saying before. So determine the amount of money you need to obtain your goals, meaning, do you want to retire when you're 60 years of age? How much are you going to need to last you through your golden years? Assuming you'll live another 20 years, for example, or 25 years, etc. Right? So specify the amount of money you currently have available to fund your investments. Start small and go forward from there. List different investments you want to evaluate. This is the learning process, and this is the beginning of the learning process, and you'll go over this multiple times in your life, evaluate the risk and potential rate of return for each of these. And being careful, of course, and reduce the possible investments to a reasonable number. So kind of winnow that down, skinny your options down. Choose at least 2 different types of investments. And this is, again, we'll talk more about this. This is where mutual funds come into play. Continue to evaluate your investment program. Give it a look at least every quarter, every 3 months, right, to see how things are going. So onward, the factors that reduce investment risk, recognize your importance of the importance of your role in personal investment, keeping tabs on these things. Evaluate your potential investment, monitor the value of your investment, not daily. Quarterly is typically good enough after you have things moving. Keeping accurate and current records, just track your investments over time. Seek the assistance of a financial planner if, in fact, you need one. You can go through this on your own. It's less expensive for one, but if you're not comfortable with these things, the way you get comfortable is by doing at least one of two things. Hiring somebody that can do this for you, financial planner, or learning this process yourself, going through what's involved with these investments. And also, of course, when you're 59 and a half is the golden age right now, meaning that prior to that, you would be taking a 10% penalty if you were to sell off some of if you had a 401k or if you have an IRA, the tax consequences can be significant. You have to really be careful. It's retirement income for a reason. You're saving that for when you retire. A lot of different options that go along with it, but that's one thing to keep in mind. So the wonderful part of this is the sources of investment information. Use the various sources that you have available. Internet is also always out there available for you to track your investments. So they have Yahoo, Bing, Google, etc. out here, but one thing you can do is you can go directly to like a mutual fund, Vanguard.com, for example, and you can click on one of their mutual funds. The broad-based one, it's the Total Market Mutual Fund. Anyway, point is you can see how it's performed over the course of the last year, 5 years, year to date, for the life of the actual mutual fund itself. And you can also look at such things as compare it to what's called the S&P 500 and so on and so forth, the different measurements of groups of stocks that are kind of put together, if you will. Or we always see the Dow Jones number that's published on a daily basis, and you can always look it up online. Just Google Dow Jones, DOW space JONES, and you will get where the Dow is at that moment in time. And those are just indexes of groups of stocks that are kind of clumped together, if you will. So other sources of investment information, newspapers, news programs, so on and so forth. There's a whole list of things. Morningstar is an important one for mutual funds. Again, for example, Morningstar is kind of the go-to to determine such things as cost of the mutual fund, rate of return, of course, and the costs that are. So you may have a very high rate of return with a mutual fund, but there may be significant costs. So it reduces your overall rate of return. These are all things to, again, pay very close attention to. So again, there are a zillion different sites. Just a couple of these that I want to look at. One would be Kiplinger, and another would be the Motley Fool. So Motley Fool, you can track a lot of these things, and Kiplinger does the same thing, kind of what we were talking before about Morningstar. Okay, so off we go.